Welcome to another episode of Bulls, Bears, and Blockchain on Revolution Radio, making smarter financial decisions with your host, Rob Nelson, former Fox News host and anchor at Roundtable Media with his team of market masters, Marc LoPresti, Managing Director of Moneta Advisory Partners, co-founder of Battlefin, leading data platform, and a former institutional equities trader at Lehman Brothers, Alex Mascioli, founder of Trade the Chain, former head of institutional prime brokerage at Bquant, John Najarian, co-founder of Market Rebellion, former co-host of Halftime Report on CNBC, and co-founder of Option Monster and Trade Monster. Daily data insights and ticker updates direct from three of the world's top TradFi, legal, and crypto experts on Bulls, Bears, and Blockchain every Monday and Friday on all your favorite platforms. Let's get started.
Good morning, good afternoon, good evening, depending on where you are and when you're listening. This is Revolution Radio's Bulls, Bears, and Blockchain. I'm Rob Nelson, and I'm joined by my team of market masters, John, Marc, and Alex, and Tom Essaye from the Sevens Report, who provides the Monday Global Macro Overview. You listen to hear the smart moves to make, and we're here to deliver just that. Great insights and info in half an hour. Good to see you guys. John, welcome back from your travels. I imagine you had fun, as I know you did, skiing and flying and making money on the side. It's a good life.
Yeah. If you've never been to Venice for Mardi Gras, it's kind of like if you went to Mardi Gras in New Orleans and you didn't have all the drunks that were just throwing up everywhere. Instead, you've got everybody walking around in Renaissance costumes that cost them, from $1,000 on up, Rob. And then we went skiing, and this week I'll head over to Madrid for a big family office conference.
Always on the go. Well, listen, for what it's worth, I went paragliding today in Puerto Rico, 2,000 feet up, and talking about getting a bird's eye view and stepping back, which is what we're going to do a little today after we get each of your big top three insight picks. We're going to look a little bit at the market and whether we need to all be stepping back a little. Alex, Marc, Tom, thanks for being here. I'm going to start it out with you, John. Okay. Give me your top three option idea picks.
All right. AstraZeneca. We've seen pretty good activity in this name, Rob, for the last week. Several big institutional players buying in calls of AZN, AstraZeneca. So that would be the first this week. The second would be HYG, which is like a high yield bond. And we all saw that rates went up pretty good last week. High yield bonds, when rates go up, bonds are generally going down. And so somebody's buying a lot of puts out in April, 30,000 puts out at the April 72 put strike. So that's a lot. And we paid attention to that. Lastly, I'd say the Apple trade. Apple keeps getting up, Rob, against this resistance right around this 145 to 147 level. It was basically 146, right in the middle of that on Friday when people came in and bought March 146 puts. So these are puts that expire in 3 weeks. We just thought that was interesting because everything we've seen seems to be somewhat positive, but the charts maybe not so in Apple.
And what do you think is going on there with Apple? What's the I mean, I know there's probably a lot of factors and people are tossing it around, but what's the main thing you think that's making it hitting that sort of ceiling and not moving?
The fact that so many people have profited so mightily from this stock, and yet some people would say the law of large numbers, Rob, that never applies to stock. That is like putting what about gravity and stocks? Has nothing to do with stocks. Neither do the law of large numbers have anything to do with stocks. But technically, the stock is right up against resistance, and it's likely to break through and then fall back. I would buy it on the fallback. I would not chase it right here.
Okay, good. Thanks. We got AstraZeneca, HYG, a high yield bond, and Apple for your three options. We'll see how they do at the end of the week. Marc, let me go you number two. Three good equity picks, as always, and your insight behind them, because that's the juicy part that everybody loves.
I love how I'm number 2, right? When John's around. When John's not around, I'm number 1. I just want to point that out. There's a certain implied inequity here. I'm okay with it. But I just, I think our listeners are going to start to get the picture, Rob, about who ranks number 1 in your book.
And I thought about switching it, but I thought since John's been gone, I should let him go first to give him a chance. But, that's fine. I'm going to pull it out of a hat from now on.
Oh, come on. We just bring a little levity to the show. So I've actually got 2. I didn't have 3 this week. I'm only going to bring stuff that I like and not stuff that I don't. And with volatility on tap, that is one thing I guarantee. And John, who touched on it earlier, a lot of the signals that we look at on the option side is portending some pretty serious vol for all of this upcoming week. But one bright spot we're looking for that's reporting on Tuesday, we're ending earnings season this week, is AAP, not AAPL, not Apple, but Advance Auto Parts. Advance is reporting on Tuesday, and we're actually looking for this name to meet or beat the street's expectations. And why, you might ask, Rob? Used car supplies are down, all right? We actually had a 13-day supply lull year over year. And while there was an indication of falling used car prices, at the exact same time, that same metric for January, wholesale prices for used cars are up 2.5%. Inventory is still, unfortunately, robust. Car dealers are having to pay more for the cars that they buy and put on the lot for sale. What does all of this mean? I am spending more to take care of the car that I currently have. I'm going to places like Advance Auto Parts to keep my car healthy and on the road. The other thing I'll point out, by the way, in terms of the data that we look at, is the record-breaking number of consumers, 80+% based on some estimates, Rob, of consumers that have actually bought their cars out from their lease arrangements in the last 2 years. You have never seen lease buyouts at those levels ever since we went from horse and buggy to combustion engines.
Before your second one, Mark, just a quick question on that, because I've been wondering about that. Is this a good time to be buying out your lease if you have it? Because generally people are like, don't do that, or it's, but if you are a car leaser, is there a reason why now that would make sense versus another lease or buying new?
Well, listen, certainly the expectation is that these conditions are going to remain this way for longer. Bad news for buyers of used cars, but it depends really on the terms of your lease. There's one that I need to renegotiate pretty soon. I won't say with what manufacturer, but it all depends on the bells and whistles in the contract. Just to round it out, by the way, Rob, on Advance, we liked O'Reilly Automotive, another name, a competitor to Advance. They reported last week they beat the street's expectations handily at $8.37 a share. The street was looking for $7.71 a share, a very substantial earnings surprise. The street's looking for Advance to come in at $2.43 a share on year-over-year growth of about 17.4%. We're looking, our data is showing us something closer to 250 or 252 when Advance Auto Parts reports. They closed, of course, on Friday, $138.85, off about 2%. Sticking with the automotive theme, Rivian, another one of the major contenders in the EV space, is also reporting on Tuesday. The street's looking for Rivian to report earnings of negative $1.90 a share, which, notwithstanding the negative earnings print, would represent year-over-year growth of 22%, roughly 22% and change, on revenue of $713 million, which is up a whopping 1,200+% from the same time a year ago. And we look, obviously, also, Rob, for the tea leaves and the data. The consensus estimate over the past 30 days has been revised on average of 50 basis points. This is a name that's beaten the street's estimates 2 out of the last 4 times it's reported earnings. Shares trading down, closing the week almost 6.5% on my beloved Lucid getting taken out to the woodshed with, of course, the rest of the market volatility that we saw on Friday. But, of course, like with all these EV names, Rob, the key is whether or not these guys can lower their cash burn and get profitable. Rivian currently spending about $200,000 to manufacture a car that they get about $80,000 for. So that's pretty upside down from a revenue model. That's a negative 70% gross margin compared with Tesla's average of 26% gross margin. So we're going to be looking to see how that pans out on Tuesday. I am cautiously bullish on Rivian reporting on Tuesday.
Awesome. Great stuff. And it's all in the auto sector. I like it. Last week it was travel. This week it's autos. And man, Marc is like a machine of data. Like he's the all data guy. He's one data point after another. I love it. Really good stuff. Okay. And volatility is on tap, and we are going to talk about that a little bit later in the show. Alex, you're up with crypto. Volatility is a little on tap there too.
It is. First, I just want to say I love Marc for being a car guy this week. I think he's spot on. Used car prices have hit an all-time high this month for the longest time. So I think he's spot on with that. And also, I got to throw him kudos for last week's call of bookings.com. I mean, he was the life raft in the storm of volatility then. So congrats, Marc. Heading on over to crypto, we got a total market cap of about 1.08 trillion right now. Trading volume sitting very light at about 34 billion, about half from the last time we were on. I reported that Bitcoin at 23,600, up just under 3% for the day, with trade the chain sentiment indicator at neutral, 45 out of 100. Ethereum 1640 up 4.5%. Really doing its work today with the sentiment neutral of 43 at 100. Stablecoin exchange net inflows, outflows about even, slightly higher with the inflows in the last 24 hours, but nothing that is causing alarm or outlying for us. Now, just like Marc, I'm only going to do 2 this week. It's because last week was a rough week. I want to make certain on what I have conviction about. But the two standouts are Urine Finance, ticker YFI, up 13.9% in the last day, up 34.6% in the 7-day. Trading volume up 130% versus average, with tweet volume hitting 118% versus average. It's sitting at about $367.5 million market cap, with the sentiment indicator at bullish 63 over 100, and that's just for the daily. Now, for all those that don't know, this is ranked 115 on the coin market cap index of largest cryptos, and Urine Finance is an automated aggregator which helps investors maximize profits from their yield farming. The second is one that I've covered quite a bit, I think, on a handful of shows so far, even before the current news that broke, which I know we're going to talk about later, and that's Optimism, ticker OP, up 8% in the 24-hour, up 12% in the 7-day daily. Sentiment is bearish, neutral, but long-term is bullish with a score of 84 out of 100. And again, Optimism, because we're going to discuss it, is an L2 blockchain on top of the Ethereum, helping scale the Ethereum ecosystem, utilizing what they call the optimistic rollups. And that means transactions are trustlessly recorded on Optimism, but secured on Ethereum. It's lost some ground with the macro market environment, but Coinbase just built on their stack, launching an L2. So we're going to hear about that. I just want to say, and I know that Tom's going to cover macro, but what we're looking out for this week, and I think it's really important coming over the volatility, couple things to keep in mind. Fed governors are set to speak every single day this week. Markets are pricing in a 30% chance of a 50 basis point hike in March. We're keeping an eye on both of those indicators for crypto volatility. And if we don't get too much selling on Monday, we may see the market stage a slight recovery rally from our end, providing the Fed governors are not too hawkish. So that's what we're looking at going into the week.
Awesome stuff. Tom, just before I bring in quickly, Alex, I ask you this often, but given what you just said, and Bitcoin itself has had a nice rise overall, I've heard a lot of whispers, expect it to probably perhaps dip under 20 again before it continues upward. Is that something you would share?
Yeah, that's something we're keeping an eye out on too. We'll probably have more of a conviction on that movement going, as we complete this upcoming trading week. But that is definitely a possibility. I've been bearish on it going below 20 for quite some time, but we have to see how the market operates with that, because as we all know, COVID has signified a change of mannerisms for the market. We get good news, bad things happen. We get bad news, good things happen. So we're still trying to figure out how this transformation is going as we get out of a COVID era, as we get back to business and stuff like that.
Okay, awesome. Thank you. Just checking, maybe I might wait just to buy a little more after it goes under 20. Again, we're not telling anyone what to do, just what we do. Tom Essaye, Global Macro, 3 minutes for you. What are and you do, just so everyone knows, Tom Seven's report does 7 every day, 7 indicators, things to look at. We do 3 on our Monday show. Always good to have you, Tom. What 3 you have for us today?
Hey guys, thank you very much. So the key indicators this week are basically going to extend the conversation from last week. Last week, and especially Friday, the core PCE essentially revealed what a lot of us have been afraid of, mainly that disinflation is slowing, and disinflation is the decline in inflation. It's slowing and possibly reversing, right? That is why stocks dropped on Friday. It's kind of why they've dropped really since the beginning of February. So the 3 data points we want to watch this week, they all come from the ISM surveys. So there's going to be an ISM services survey. It's later in the week. That is not going to be as followed as the ISM manufacturing survey that comes out tomorrow, but it's more important. All right. So kind of look through the financial media coverage of this. Watch that ISM services PMI. It needs to be stable, right? The market does not want to see it get too hot, meaning the economy is overheating, i.e. Fed hikes more, or too cold, meaning that it plunges and all of a sudden we got to worry about stagflation. The other 2 indicators to watch this week are both price indices that are in the ISM manufacturing and services PMI. These have acted almost like a leading indicator for disinflation. They started to drop really in late Q3 and Q4 of 22, and they led the official statistics lower. They also have leveled out lately. So again, kind of forecasting this this slowing down of disinflation. We want both of those price indices, both in the manufacturing and services PMI, to decline. If they do, this market can stabilize and even rally.
Good. Thanks, Tom. And you'll stay with us for a couple minutes. Yeah, can you hold? Because I want to talk a little about, particularly about the PCE and bring everybody in. But John, let me start with you because you made a note before the show about inflation going up, but the PCE, spending continues. Like people are still spending. There may be a lot of reasons for that. They may just be like, I put off my vacation long enough. I don't care. Like I was living in COVID hell for too long. But that tied with the hotter than expected inflation data, your point was the Fed's not done tightening and we may not be heading for a soft landing at all.
Exactly, Rob. The PCE, personal consumption expenditure number, was hot. That is not what anybody on the Fed wants to see or hear. And obviously that means consumers are having to spend more money. Some of them are able to, some of them are putting it strictly on credit cards, meaning it's not really their money yet. They're basically hoping to be able to pay that off or write it off, depending which way it goes. And either way, that's pushing up the inflationary genie that's already out of the bottle. So I would say what we've got to worry about is the Treasury yields on the 2-year hit 4.8 last week, 4.8%. That's the highest since 2007, obviously well before the financial crisis and or this most recent money thrown by the Fed to Americans. That really is what's behind inflation, at least to a certain point. And I think volatility that at the beginning of February, Rob, was more like 17 for how we measure the VIX, the VIX. Now it's 21 and change. Percent-wise, that's a big move, but we all know the VIX kind of oscillates wildly depending on people's outlook. And I think that outlook right now is that we're probably going to hear more hawkish talk from the Fed, various speakers like Alex cited. And I think that's going to be something else that the market has to deal with this week.
Well, yeah. And Tom, with the Fed speaking every day, for those who don't know, what's the significance of that? And I'm guessing you're pretty certain that they're not done. They're not done tightening up.
No, they're absolutely not done tightening up. And how could they be, right? Their inflation target is 2%. We are so far above that. I mean, we've almost been It's a different context. If I took all of us back in a time machine and took us to 2018 and I said CPI was running 5%, we'd almost all faint, right? The only reason that seems good is because it was at 9%, right? But we've got to get all the way down to 2%. And I couldn't agree more with John. Basically, this resilient inflation metric, all it does is it narrows the channel that the Fed has to thread to get this economy to a soft landing. The more they have to raise, the greater the chance that a recession hits, and it's a deep one. So listen, there's no way to sugarcoat it. Last Friday's number was bad. The data from the last couple of weeks has not been positive for the bulls. That's why we're down. We need this data to turn around, and it can. And it can. I'm not saying, everything's going to hell in a handbasket. The data can turn around, but until it does, more volatility is on tap.
Tom, thank you, and thanks for staying a couple extra minutes. Always good to have you, and we will see you next Monday, and always look forward to it, guys. So based on what Tom's saying, Marc, where are you on this, right? And I want to bring the whole idea that the S&P is, extending its sell-off, which is, the biggest so far this year. And you said volatility is on tap. I love the way you coin things. That volatility is on tap. And, look, a lot more people thinking the soft landing ain't happening. So your view on that and kind of the best market strategy right now, given that?
Well, the best market strategy, Rob, is to strap in, right? Buckle up, Buttercup. We've got volatility on the horizon, but smart money makes money during volatile times. Smart money can't make money when markets don't move, right? And I can't help but being a little bit more optimistic, a little bit more of the bull to my friend Tom's bear, although I totally agree with everything that he's saying from the perspective of what all the technicals are indicating. But as I always say, when we hear Tom's somewhat more sanguine market outlook than I portend, is whether or not this is priced in, right? Whether or not the market has decided that this is directionally where we're headed and whether or not the market is right.
Yeah. That was exactly what I was going to say. But at the top of my question, I'm glad you said that, because I was going to say, do you think it's been priced in?
Well, so if volatility implies that it's not, right? Volatility implies that the market is still trying to figure it out. So we're trying to sort of find, a directional trend and an overlying theme. I tend to think still, notwithstanding what happened last week, I tend to think still that we're heading in the right direction, that the economy is continuing to show its resiliency. I know the Fed hates that. I know this administration hates that employment is still hot and consumer sentiment is still strong. And, we should all be battening down the hatches and preparing to eat canned beans for the next 2 years. But the reality of it is that there is still remarkable resilience in this economy. So I am cautiously optimistic. There is definite volatility ahead, choppy seas, no doubt. This is not a market that is for the faint of heart or for the unindoctrinated. And that's why we continue to try to do what we do with this show, is to help people understand how to navigate these waters.
John, what do you think about, you're also big on the smart money, and you're one who's been talking about volatility a lot as well. Same kind of question, if you're looking at the best kinds of market strategies to approach in a volatile market, what do you do? And by the way, do a lot of people in the markets not really think that the Fed is going to fight till it gets inflation where it wants it? Do they think they're not serious?
I think they understand that the Fed is serious, but they constantly quote something about the Fed not wanting to make two mistakes, going too far on the hiking cycle after keeping rates too low for too long, Rob. So that's what they're hanging their hats on. I think it's wrong thinking, because, Mester and Bullard, those are two members of the Fed, of course, Kashkari, another, they have turned very hawkish, and they're all saying we need to hit this hard and keep hitting it. So if this was a Star Wars or Star Trek movie, they'd be saying, give me more photon torpedoes. We got to keep hitting it. And I think that's just what the Fed is going to do, Rob, until we finally see a meaningful drop, not these little quarter point, half point drops in the inflationary index, which we're seeing 0.5% here, down to 6% or down to 5.5%, those kinds of moves. We need to see a move down towards 4. And if at the present pace, that wouldn't hit us until August. So between here and August, I don't think the Fed's going to have that much patience. I think they're going to hit it harder, faster.
So quickly, what's a tip for investors to think about when they're looking at what you just said and that extended volatility? Is there like a practice, help us educate our audience on how they can make smarter choices?
I'd say be very wary of stocks like Starwood, STWD, or anybody who has leveraged adjustable borrowing. Starwood is, of course, a REIT. I had unusual activity in that one last week. There have been a number of stocks in this space that have exposure to higher interest rates. And if we're going to see the 2-year go over 5, which apparently is pretty close, Rob, I think we're going to see a lot of those companies get adjusted the wrong way, which is going to really hurt them. So I would say stay away from those companies or be in puts in those companies that have exposure to rising interest rates in a negative way.
All right, great insight. Thank you. Alex, want to bring you into this. Let's talk, we got a couple minutes here. Let's talk about Coinbase. You mentioned it, Coinbase launching or planning to launch Base. So Base is an Ethereum layer 2 network. And the basic idea, right, is it's a low-cost, secure, developer-friendly environment you can build a lot of decentralized apps on. The bottom line, you tied that to OP because they're building it on the OP stack. But I'm guessing the reason that's significant is, one, it's a huge deal for on-ramping people into the crypto space, right? As well as it's going to be decentralized and interoperable with other blockchains. But tell me if I'm wrong.
No, you're absolutely right. There's very relatively little out on it. What you're saying is pretty much what everybody knows right now. It's in testnet mode, but it's going to be for on-ramping, obviously for Ethereum, Solana, a couple others. What's exciting about, this to me is obviously the optimism trade. I mean, I've been following OP for a little bit. I think what they're doing is great. Base is being built on their stack. They're using, Optimism is using its optimistic rollups, as I mentioned earlier, for the trustlessness of it. I think what we're looking at, to be honest with you, is we're seeing a major player in the U.S., which is under a heavy regulatory scrutiny and eyeballs right now, start building the foundation for, I want to use the proper word in this. It wouldn't be evading, but it would be supplementing the regulated on-ramps. I think what we're going to see come out of this is we're going to see an alternative to the tight, restrictive current U.S. environment for customers and for dApp builders in general. And this might be a way to circumvent that in a positive way, not a negative way, not any sort of nefarious way, but a very positive way. So I think it's a step forward in the right direction.
Is this as big a deal as people are suggesting for the reasons you're saying? Does this have, Coinbase is huge. So, does this have the ability to be a real shift maker?
I really think it does. I think, and if you're going to have somebody doing it, Coinbase is right there at the forefront with the experience, with the balance sheet to be able to fund this through its testnet cycle to say, hey, listen, this experiment works or it doesn't work. Also, you got to remember that it's going to be open for dApps to be built on it by dev teams. So they're going to get a lot of help throughout the ecosystem, and I think they're one of the few right places to be launching this.
And notice that they said they're not going to have a native token. And guys, John and Mark, feel free to jump in on this, but is that connected to the fact that this whole, they don't want to have any SEC issues, or is it not about that at all?
Well, let's get this out of the way first. I mean, Gensler just did an interview with New York Mag and basically said everything besides Bitcoin is a security. Let that just sink in for a moment from a regulator giving a magazine interview. It's a blanket statement that is so highly disruptive that nobody should, Coinbase definitely should not be launching a token. They're still fighting the SEC in an investigation on already listed tokens that are being said to be a security from their one of their employee insider trading cases. And on top of that, they're also very adamant that they have one of the most rigorous token onboarding regimes out of any exchange in the world. So if you're trying to poke holes into Coinbase's vetting process, I think Coinbase is being very prudent here.
Before we go to our picks, our put your money where your mouth is picks, Marc, just you've brought up before your frustrations, obviously, as we've all talked about with the SEC. But to Alex's comment that just about everything is going to be viewed as a security, how significant? What does that mean? And what's the thing you better look out for first? I mean, does that mean everybody with NFTs is suddenly in trouble?
I mean, what ridiculous and irresponsible rhetoric out of Gary Gensler, right? I mean, we covered when we had our friend Anthony Scaramucci as a guest on the show last week about, whether or not his days were numbered under this or subsequent administration. That is just 100% not the kind of talk that you should hear from the securities regulator in this country. So I don't know that I would be recommending that everybody in the crypto and the blockchain and the NFT industry suddenly, move to Costa Rica. I think that's a lot of bluster. And I think it's unfortunately an indication of an agency that has let things continue without guidance for far too long. That is now just sort of relegated to making comments like that. So I'm not going to lose too much sleep over that tonight.
All right. Then I won't either. All right, guys, we're just about out of time. So I want to get in our put your money where your mouth is picks. John had no pick last week. Too high up in the mountains to pick. Marc, good job with bookings.com. Up in a tough market, and it was a good call. Alex, Blur, the NFT marketplace, not so good, dropped 20%. That's okay. I mean, it happens. And I think Blur may still see its day coming. You can obviously give your thoughts on that. Give me your pick first.
Yeah, absolutely. Listen, I'm sticking with Blur. I've added to the position since that pick. Unfortunately, the macro environment got the best of me on the week, but for me, it's a longer hold than a week. Another one that's a longer hold than the week that I just full disclosure own is OP Optimism. It is my pick for this week. I believe the base protocol from Coinbase is going to drive this thing up over the next 12 months, and it's exactly my outlook for Blur as well. So I'm going with Optimism. I think these two have a lot of potential in the long run.
Alex is in on Optimism. Marc, bookings.com, great pick. What's your pick for this week?
Well, I want to say two things before I give you my pick for this week, Rob. One is a big hats off to our friend and colleague, Alex Mascioli. You cannot compare apples to apples in terms of what he does versus what John or I do in picking cryptos. There's less information. The regulatory regime is far more opaque, as we just talked about. It is, frankly speaking, a lot harder than picking equities and options. So hats off to one of the best in the business. I also want to point out, when we talk about the strength of the data, Rob, that bookings.com, and I think it would have done a hell of a lot better in the market had it not announced on Thursday night into the headwinds and the volatility that we saw on Friday. But the data we suggested, you can go back and pull the recording, that Bookings was going to report on earnings of $4 billion. The street was looking for 3.8. We nailed that. Bookings reported at $4 billion. We suggested the data showed us $21+ a share. Bookings blew that and the street away. Street looking for $20.97. The consensus estimate was $24.74. But just goes to show the power of the data. Unfortunately, really difficult and choppy markets for that stock to see the benefit of it blowing the doors off of the street's estimates. We're still bullish on booking.com. But my $1,000 money where my mouth is picked for the week is, shockingly, Advanced Auto Parts for all the reasons that we said before.
He's going with Advanced Auto Parts. And yeah, listen, to people listening, to our listeners, to Marc's point about the crypto markets, and Alex, I like that you're sticking with Blur, it's one of the reasons listening to this show is so great, even hosting it, how much I learn from how you think through and make the choices. And again, people can use that information, make their own decisions. but it's insights you're just not going to find very easily from all three of you. Compliments to you all. John, you go last since you went first at the top, and we want to keep it fair.
All right. Huge put buyer in the Spider, SPY. They've been buying in the IWM, and they've been feasting from some of those put buys. That's the Russell small cap. But my trade for the $1,000 trade would be SPY. They're buying April puts, Rob. So on Thursday, when we do the update, we'll see where those puts are. The index was 396 and change, I think, when they were buying these puts.
I think they'll be, look, you know, the word on the street is John doesn't lose money. So
I only wish that was true.
Right. Well, I think, you got to lose money sometimes. It's in for the long haul. That's part of it. You know, if you just never want to lose money, it's just like people who dive in on the crypto thing and go crazy and then are upset. Like, what happened? Why didn't I get rich quick? You know, this is about smart investing. Really fun to see you guys. Thanks for taking time on a Sunday. Alex, Mark, John, and Tom, who's already left us. And we'll catch up on Thursday and see where we're all at. Everybody out there listening, stay tuned, by the way, because on our Friday show, which we record on Thursday, we've got a special guest. Not going to tell you who it is, but you're going to want to hear it.
Today's episode of Bulls, Bears, and Blockchain is proudly brought to you by our friends at Accelerate Tax. You may not have heard of the Employee Retention Credit Program, but if you have a business that employs less than 500 people and you were opened and impacted by the terrible COVID pandemic, you need to learn about money that you are entitled to from the government. To learn more about the Employee Retention Credit Program and the good work being done at the people at Accelerate Tax, go to www.acceleratax.com.
Thanks for joining Rob Nelson, Alex Mascioli, Marc LoPresti, and John Najarian with another great episode of Bulls, Bears, and Blockchain, twice a week on Revolution Radio. Whether you're new to the world of Web3 finance or an experienced investor, we've got you covered. Follow us on Twitter at GetRevRadio and visit our website at revolutionradio.io, helping you make smarter financial decisions.